Today, we're talking about how to add $3K to your bottom line with the right property management strategies, which include how to sign a 2 to 3 year lease, how to get 70% of your leases renewed, and how you should demand that the average resident stay is over 4 years from your property management. It is like that we are live on Facebook for the Tuesday edition of the Not Your Average Investor Show. And we are testing out a new intro here. You ready for this, Greg?
Ooh, I'm ready.
If you want to own rental income properties, you're in the right place.
Check.
If you've got properties in Jacksonville that you want the best-in-class property management services with, you're in the right place.
Check.
If you're a real estate professional that is looking for a way to get an edge on the Jacksonville market and help your clients make a little bit of extra money, and you make a little bit of extra money with them too, you're in the right place.
Check.
And the next place to go is chatwithjwb.com. How'd I do, Greg?
Fantastic. How did you get all of those things checked off at exactly the right moment, man?
You know, it took a lot of practice. I am your host, Pablo Gonzalez. With me, as always, the man that we call GC because of his genius concepts, because he generates cash flows, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Thank you, buddy. Well, hello, everybody. Great to be with you.
It is great to be with our community today, already lighting up the chat. Let me move this. We got Bill Shields. Hola, amigos. Bill Shields with his patented bilingual hola. Thank you, Bill. Jennifer Filson with us. Good morning, JWB family. Carl Thompson, good morning from Colorado. Who else we got? We got Scott Belote, a Hall of Fame, Not Your Average Investor guest here. We got Nadeem Shah. Good to see you, Nadeem. We got Mark Larrett, sorry, man, you know, like this thing is abbreviating things in front of my screen, but I knew it was with an L. Mark Larrett, good to see you, Mark. Welcome back. Lou Carlson, welcome back, Lou Carlson. Jen Filson here chiming in with the pizza truck. Who else we got? Zach Correa, aloha, Zach. Good to have you in here with us today. Leo from California, good morning to you, Leo. Lee Bishop, as always, the MVP of the Not Your Average Investor Show Community Championship belt holder.
Mm-hmm.
It's up for grabs, though. If anybody wants to challenge Lee for it, you're going to have to work hard, but it is a belt that can be taken. Peter is here. Hey, everyone. Peter, welcome back. Good to see you. Who else we got? All right, that's what we're doing for roll call right now. And what are we talking about today? We're talking about property management.
Oh, the lifeblood of this business, man.
The lifeblood of
property management. How to take care of your residents so that they take care of you and your investment here.
That is really well said, Greg. How to take care of your residents.
I don't think I've ever said that before.
But I think we got a new tagline for the whole PNC
like that.
side. And as everybody knows, this is a community-driven show, right? We got the two ways to interact, the chat and the Q&A box. I ask that if you're talking to each other, use the chat. If you're talking to us, use the Q&A box. That way I don't lose track of it. I get to pick the brain of GC over here. And GC, let's pick your brain right now. Tell me about why JWB got into the rental property game.
We got into the rental property game because, you know, I'll just go back to when we started to invest in 2006. It was myself, my business partner, Alex, and my business partner, Adam Regal, and I, and we were just infatuated with this business model. We were infatuated with the idea of buying assets that were going to produce positive cash flow and that we were going to hold on to for a long time. That'd be our retirement. You know, at that point, we were 23 years old. What we were not infatuated with was actually doing the property management ourselves, which might be kind of surprising because clearly JWB is a property management company. But like many of you out there, right, we were not infatuated with the idea of doing property management for ourselves. So in the beginning, in 2006 and 2007, my business partners and I bought about 40 rental properties. We learned how to use smart debt effectively. We learned how to acquire the assets so they produce positive cash flow. But what many people don't know is that in the beginning, at that time in 2006 and 2007, because we were not infatuated with the idea of property management, we actually outsourced it for our own properties, which is very, very common. I'm sure many of the people who are watching the show right now have similar ideas. They love the idea of acquiring the asset. They don't love the idea of potentially getting the calls or collecting the rent or having to deal with potentially an eviction or anything like that. And that was us. That was my business partners and I. So we got into property management flat out because when we outsourced it to other folks, it wasn't a good experience. it was such a bad experience. I didn't understand what was happening, because if I even go before we outsourced it, we had maybe 30 or 40 units by that time that we outsourced it. When we had like 3 or 5 or 10 units, we actually managed it in-house for ourselves. And we were really good at getting long-term leases, and we were really good at getting residents who were going to renew, and we were really good at dropping maintenance rates. And so then once we got to, a scale of like 30 or 40 units, we outsourced it. We went to a property manager here and said, hey, this is what we'd like to achieve. We assumed that it was going to be that same type of experience. We assumed that it wasn't that hard to do. We assumed it was more like a commodity out there. We could just go with somebody out there who had a good reputation. They do it well. We were so disappointed. I remember that year that we outsourced it, our rent collection was sub 80%. Right now, just for perspective, we collect 98.5% of rents. So our rent collection was sub 80%, dropped, 15, 18 points right off the bat the first year that we outsourced it. Every resident that we had was signed up on a long-term lease. And all of a sudden, when those residents were now signed up on new leases with this other property management company, they only signed 1-year leases. And we said, well, what's going on? And they're like, well, we just can't sign long-term leases. That's really hard to do. We just can't do it. You're going to have to make the decision between, do you want it rented for a 1-year lease, or do you want to go for 6 months and try to get a 2-year lease? We just didn't think that question was right. And then resident renewals never happened. So it was just really terrible experience for us right off the bat. So much so that it made us think about this. And we said, well, geez, our business model at that point soon after became, how are we going to package what we're doing from a rental property investment perspective for ourselves? How are we going to package this experience for others? And it dawned on us. And we said, if we really want to package this to be something that other people are going to be successful in, there's no other way to do it other than if we become the best at property management. So when we're kicking off the show here and we're saying, what are we going to talk about? And you see me lean in my chair and get really fired up about property management, it's because this is the lifeblood of turnkey rental property investing. You cannot be a great rental property investor. You cannot be a great turnkey rental property provider unless you are the best at property management. And as we're going to see here, as we go through some of the numbers and the case study that we kind of put together, I'm going to show you exactly why other people fail at rental property investing. I'm going to show you why other property management companies, there's a big difference. I won't say that they all fail. I'm just saying there's a big difference between why they do things a certain way and the way that JWB does it. And at the end of the day, it's going to equate to thousands of dollars each year that you're either going to have in your pocket as a rental property investor or you're not. And it comes down to the strategies that we're going to talk about here today.
So let's talk about it, Greg. You talked about getting into the game and being severely disappointed by the inability to keep tenants in the home and the inability to collect cash, right?
Important, right?
Sounds like the lifeblood of property management. What have you found? What were the reasons that was happening?
Well, so I think it all comes back to an alignment of goals or a misalignment of goals in that case. And as I've studied more and more and I have more experience in the property management industry, I understand that it's a real shame that the goals of a typical property management company are not in line with the goals of a rental property investor.
How so?
Well, so if you think about it, as a rental property investor, your goals are to earn the best risk-adjusted return on investment, right? Risk adjustment comes from positive cash flow. And what we know to be true is the longer a resident stays in your home, the better your positive cash flow is, right? The better your risk-adjusted returns are. Why do you think that is?
I would assume that the resident A has a little bit of ownership of the residence the longer that they're there, but B, more than anything, is the fact that you don't have to remodel, you don't have to paint the floor, you don't have to replace the carpets, whatever you're doing, right? It's that turn cost that's big.
Exactly. The turn cost is the brunt. It's the majority of all the maintenance and vacancy costs. The turn cost makes up a huge percentage of your overall maintenance cost. Most people don't understand that. They're willing to have a resident leave every so often. They say, well, geez, what if I can get higher rent? Then I want to get the highest rent rate. At the end of the day, if you get a higher rent rate, but it takes you a turn to do it every single year, you're going to lose. Your returns on investment are going to go down. And so we learned really quickly because, again, we owned rental properties, right? That's another thing. Ask a property manager before you do business with them if they actually own rental properties. When you actually own rental properties and you're paying the mortgage when it's vacant, or you're paying for the turn every time that it goes vacant, you quickly learn, if you measure this, that your maintenance and your vacancy costs are going to skyrocket if you allow short-term resident stays and you allow multiple turnovers that happen. If they happen on a yearly basis, you're in a tough spot. So if you know as a rental property investor that the longer your resident stays in your home, the better you're going to be, the better your risk-adjusted returns are going to be, what do you want?
You want to keep them in your home.
You want to keep them in your home.
Yeah.
You want to treat your residents like gold. You realize that you need to make sure this is a customer service experience for them as well. It needs to be a win for them. And then you want to keep them in your home so that they take care of you and your investment, right? Take care of you and your investment mainly means by paying the rent.
Makes sense.
Pay the rent, then your risk adjusted returns go up. You get to hold on to this asset for a full market cycle, and that's how you really win. Well, when I talk about a misalignment of goals, if we all understand that long-term resident stays mean less turnovers, mean lower vacancy costs, lower maintenance costs, if this is the path, the question that I pose to a lot of new investors, especially those who call the office or, those who I'm speaking to, nationally or whatnot, why is the standard? Why do almost all property management companies out there sign 1-year leases?
I outside of the fact that they're not property managers themselves and don't know any better, I would assume it is because they make money based on the fees that they charge, and those one-time fees that they charge for a turn is the moment that they make money as opposed to the moment that you lose money.
Exactly. If you follow the money, you typically find why people act a certain way or an entire industry acts a certain way. So let's follow the money here. Right? So JWB is a property management company, right? I can tell you how the books work for JWB Property Management. And JWB Property Management has actually already acquired 3 property management companies, 3 or 4, can't remember, 3 or 4 property management companies in the last 2 years, right? So we get to see all of their books before we make the decision to buy that property management company. So I know exactly how property management companies work. And when you see what percentage of their revenue comes from a certain activity, you're going to see what activity they are really focused on doing more of, right? So let's put our property management owner hats on here. I don't see you have your hat on.
It's because I have these.
It goes like this.
On.
This is how you put the hat on.
I'm not on camera. All right, hats on.
So let's put our hat on. All right. If you're a property manager and we're going to follow the money, let's break it down this way. All right. As a property management company, you earn tenant placement fees. Tenant placement fees are the fees that you earn by putting a new tenant or resident in your home. We call them residents because they stay forever. Other property management companies call them tenants because short-term tenants stay.
They're turning.
Yeah, they're turning. So a typical property management company is going to earn about a month's rent for tenant placement. Okay. So you've got a property, Pablo. You're a property management company and you rent this property out. It's $1,000 rent and you earn 1 month's rent for your tenant placement fee service. How much money did you as the property management company earn?
$1,000 rent. It'd be easier if you made it $1,200 rent, to be perfectly honest, Greg, but I'll do some quick math and say it's about $800.
Well, you earn 1 month's rent,
which should be
$1,200. You're getting to my next example.
Oh, okay. I was thinking $1,000 and you know what it is? I don't have the hat on. I don't have the hat on.
Get your hat on, man. Get your hat on.
$1,000 a month in rent.
Yep.
And I earn 1 month's placement.
There you go.
I earn $1,000 when I place a resident.
There you go. You're thinking from the owner perspective. You want that thing to be lower. Now, so the property management company in that example, it's $1,000 rent. They rent it out day 1. They earn $1,000.
Yeah.
All right. Now, the next source of revenue for that property management company are property management fees. Okay. Typical property management company will earn 10% of the monthly rents that they collect in fees. Mm-hmm. So for that same property, it's $1,000 rent and that property management company earns 10% each month. All right. Month 1, what do they earn for their fees?
They would earn $100.
$100, right? Over a year times 12, that gets us to $1,200. Now for that $1,200 that they earned, let's think about how much activity had to go into that. And then let's think about what the dollar per hour activity, best activity is, right? So for that $1,200 that property management company earns at the end of the year, they had to do all of the customer service. They need to make sure that people are there to answer the phone to make sure your residents are taken care of. right? They need to make sure that they handle all of the accounting to make sure that the numbers are in the right place for the owner and for the resident, right? Need to make sure they're there to handle any maintenance items that come in. And guess what? Maintenance items happen every once in a while. And the number one reason that a resident leaves is if it takes too long for the property management company to resolve those maintenance issues. So they got to be on point there. They got to manage that vendor database, right? Is it always easy to manage contractors, Pablo?
No, it's not.
No,
it's not.
But you're doing all this, remember, for $100 a month, okay?
Yep.
Evictions, right? Can evictions happen? Absolutely, right? You got to make sure you take care of that very quickly to the letter of the law and make sure that you do that for the owner's best interest, right? Geez, what else? What else? I mean, there's a lot that you are doing, right? And how much you earn each month?
$100.
$100. All right. So at the end of the year, how much did you earn?
$1,200.
Okay. And let's go back to renting that property. Day one, how much did you earn?
$1,000.
So you, as the property manager, you've got your hat on, right?
I do.
The hat's on.
I have it on. Yeah.
Okay. The hat's on.
I have it on like this.
It's keeping it on.
Keeping it on.
So you, as the property manager, you have the option, right? Where are you going to put your resources? You earn day one that you earned $1,000, or where you work for an entire year for that litany of items that you need an entire staff to handle for you, and you make $1,200. What would you rather do to grow your business?
It seems like I'd rather just find one tenant and get paid $1,000 than serve a whole bunch of tenants and do all these different things for 30 days.
There's no denying it's the best dollar per hour activity for you.
Yeah.
And so what this leads to is, I'm not saying that other property management companies have a business plan built on kicking your residents out so that they can put new residents in. That's not where I'm going, but I can guarantee you that they don't have a business plan built on removing tenant placement fees and extending tenant durations, right? They are not staying up late at night thinking about how can I take your average duration of your tenant stay from 1 year to 4.5 years, right? Why would they not be incentivized to do that, Pablo?
Because then they would literally be making their ROI of the time that they spend on activities go down.
Yeah. As a business, your job is to manage your resources to produce your best dollar per hour activity. That's how you grow as a business.
Okay.
Right? If they were to go and to sign long-term leases and to focus on lease renewals, their revenue for their business would drop substantially. If they were to go from signing 1-year leases to 2-year leases, simply put, that's probably going to be a half of their revenue stream. Half of the tenant placement fee is gone.
Yep.
Are you going to want to do that?
No, especially not when I can just chalk it up to an industry that's just like, hey, this is just how the industry goes.
I'm just going to fall in line with the industry, right? Industry standards 1 year.
Yeah.
I'm not going to rock the boat.
Yeah. So you realize that is the misalignment for the typical property manager. Why is JWB? I'm assuming that JWB is aligned in a different way.
Absolutely.
Number one, you are a property management. You are a rental property investor yourself, right? So like you come from a place of empathy and understanding the pain points because you are your own client. Is it just that, or is there a financial incentive of alignment?
Well, there's definitely a financial incentive as well. And I think anytime you have a partner that you want to be investing with in any type of investment, you want to make sure that that partner is going to make more money when you make more money. That's how you have a relationship that spans decades, like the relationship we just had with Tim Hicks, who was on the call last Tuesday and talked about how he started to buy properties with us in 2012 and he's going to be buying more now. You have a long-term relationship when the person who you're working with makes more money when you're making more money. So let me tell you how JWB makes more money when our clients make more money. Most property management companies earn between 25 to 50% of their revenue from tenant placement fees alone. 25 to 50%. So if you were going to go to them and say, hey, I want you to make half of that by signing 2-year leases, they flat out can't afford to do it. And oh, by the way, it is much harder to sign a 2-year lease and a 3-year lease with a resident than to find a resident who's only going to sign 1-year leases, right? So you're asking that property management company to do something that they just flat out, even if they wanted to do it, they can't do it. They can't afford to do it, and they're certainly not going to be excited about the additional work. So question would be, what's different about JWB? Well, JWB is a property management company, right? We understand this is the lifeblood. Our investments don't work unless property management's top-notch, and that's in-house here at JWB. But we do not make the majority of our revenue from tenant placement fees. We actually knowingly give up a substantial amount, millions of dollars every single year when you total it up. We give this up in the form of tenant placement fees that we could charge if we just went down to 1-year leases. We would have shorter resident stays. We would make more money on tenant placement fees, but it doesn't make sense for JWB to do that, because what JWB does, which is different than every other standalone property management company, is we sell houses. We sell turnkey properties. Normal property management companies don't have something else to sell. All they sell is that property management services, and they have to maximize their fee structure to make it work. For JWB, we make the majority of our money through home sales. And that's what you want, because we bring clients on with an understanding of the assets they're going to purchase today. We also build a plan to understand what assets they're going to need in the future to help them reach their passive income goals. And then we know that the only way they're going to come back and buy more houses from us is if we hit those goals, right? Sometimes our plans with clients are 3 years, 5 years, 10 years. That client's not going to come back 10 years later like Tim Hicks is and buy again if we have excessive maintenance costs, if we have excessive vacancy cost, if we have excessive turnover. It's just not going to happen. So this is how JWB makes more money when you make more money. We knowingly give up a substantial amount of property management fees, and we knowingly work harder. We build our property management company to work harder to get 2-year leases and 3-year leases so that your return on investment is better than what we told you. And then you have the choice to come back to us and buy more properties and tell all of your friends and your family about it. And that's what's proven to be true. And so by this beautiful arrangement that we have, where goals are actually aligned, you're incentivized to have lower fees. And then we're incentivized to do that so that you come back and buy more houses. Then we can all win together. And to me, it's a real shame that the property management industry has gone so far with this other sort of standard way of doing things. It takes this incredible asset class of rental property investing, which, I'm biased, but I believe it's the best risk-adjusted return out there, especially today. And it gives people a sour impression of being a landlord. Yep. And think about how much wealth could be created. Think about all the positive things that could be created if we just had an alignment of goals from the manager perspective, right? So there you go. I'm on my soapbox. Now I'm off.
I got it. That was a glorious soapbox. And it makes a lot of sense. It explains a lot of the conversations. When I first started working with JWB, and I was excited and telling my friends before spending a year plus on the Not Your Average Investor Show and actually knowing a little bit of what I'm talking about through osmosis, I would hear about these terrible experiences, and I'd hear about like, yeah, but are you really making money, man? Because, this, that, and that's how they get you, and this and that, right? So you painted a really good picture of what the pain point is and how the experience doesn't match what you think it's going to be when they just show you a pro forma, right? Then you painted a really good picture of why that's happening, right? Like the misalignment of goals makes a ton of sense. But what we teased this call for was, how are you going to save $3,000 a year in property management fees? Why don't we go through that example, talk us through the way that these long-term leases and that treating your resident as a resident, not a tenant, how that actually pays me as an investor.
Let's do that. All right, let's start with the example as if you are going with another property management company, because what I want you to see is that it's not a surprise or a mystery why many people complain about having higher maintenance cost and higher vacancy cost and lower returns, and why it's probably not something that it's probably something that you've heard from friends, family, colleagues who are thinking that you're thinking about getting into rental property investing. And they're saying, what are you thinking? Why would you want to do that? That sounds terrible, sounds hard, sounds, not like a great investment, right? Well, here's numerically why this happens. All right. So what I did is I put a 5-year case study together. Okay. And you'll want to follow along at home here. Okay. So we're going to assume that you've got a property that rents for $1,200 a month. And we're going to look at all of the costs that are associated over a 5-year period. We're going to compare this misaligned goals way of doing things for other property management companies. And then we're going to compare it to an alignment of goals way of doing it, which is the JWB methodology. So for other property management companies, average duration of resident stay, typically about a year. Why is it that way? Well, they sign 1-year leases and they don't care very much about resident renewals. Again, why don't they care much about resident renewals, Pablo?
because they make more money when the resident doesn't renew.
If you've got that hat on still,
I got it on.
and you're trying to drive growth for your property management company, if you were to focus on retaining your residents, it's actually dropping your revenue. So average resident stay is 1 year. All right, over a 5-year period, let's talk about the tenant placement fees that you would have paid. Now, tenant placement fees for other property management companies may come in somewhere around 75% of the monthly rent that is collected. Some are 100%. I'm just going to go conservative here and just say that the other property management companies actually charge less on tenant placement fees than JWB does. Because I want to prove the point here that cost of a tenant placement fee upfront is not the most important thing if you should be paying attention to. Long-term resident stay is. So let's assume that they make 75% of the rents that they collect in 1 month as their tenant placement fee. So it was $1,200 a year was the rents that they, for that property. Day one, they're going to earn 75% of that. In this example, that's $900 that they're going to earn for one tenant placement fee. If we go over 5 years, that's going to be $4,500 of tenant placement fees that this other property management company would have earned. So write that down, $4,500, right? That's part of your cost structure. Next, let's look at vacancy cost. Vacancy cost is the loss of rent that you're not earning while your home is vacant, and it's substantial, right? So for your vacancy cost, that would be $1,200 a month here. If you have a tenant, a tenant that turns over every year, you're going to have 4 periods over a 5-year period. You're going to have 4 periods of vacancy. I'm just going to assume that those last for 2 months each. All right, for JWB, that's about right. It's even less right now. But for other property management companies, we're going to assume that they're up to our standard, which may or may not be the case. So 2 months each at $1,200 means $2,400 every time that happens. Times 4, that comes out to $9,600 over a 5-year period of costs that are coming your way. Write down $9,600.
Greg, just so you know, I'm sharing the example right here to everybody so that they can follow along.
Well, what do you know?
What do you know? That's what happens when I put my hat on.
Now we're going to go to cost of repairs during tenant turnover, right? Every time your resident leaves, your tenant leaves, expect that you're going to have to take some money out of your pocket and you're going to have to pay for it. You're going to have to pay for the maintenance items. This idea that residents are going to leave and that's going to be covered by your security deposit really just doesn't happen. Sorry to break it to you. So the average out-of-pocket expense for a resident turnover comes in at about $2,500. So if you've got 4 of those turnovers that happen in a 5-year period, again, for another property management company, 4 times $2,500, another $10,000 of costs that you're going to experience over a 5-year period. So we've got $10,000 of cost plus $9,600 of cost plus $4,500 of costs that are coming your way because of the management style structure strategy of another property management company. You total all that up, carry the niner, $24,100 of real costs. And this is what people experience when they work with any old property management company who signs 1-year leases.
Greg, did I hear a niner in there? Were you calculating it on a walkie-talkie?
I mean, any Tommy Boy reference I can throw into our show, you know that I'm going to throw that in there.
I love it. I love it. I love it. All right. So that is what we just did here. $24,100 in a average. How long, Greg? 5-year case study, right? We have it up on the top. So in 5 years, that's $24,100. Now talk us through the numbers with the JWB example.
Well, before I do that, I want to drill it into maintenance cost and vacancy cost.
Okay, great.
Because this is really critical, right? Where a lot of turnkey investors kind of feel like they're burned is that evaluation that they buy the property based off of has a certain maintenance cost and vacancy cost expectation there. Common ones are 5% for maintenance, 5% for vacancy, or 7% for maintenance costs. This is industry standards that many turnkey companies actually don't have a numerical basis for putting this on their evaluations, but a lot of people in this industry just do what everybody else does. So let me walk you through. If there is a turnkey company who is putting a property evaluation in front of you, and they're giving you maintenance cost of expectations of 5% or 7%, and their property management is outsourced, and they only sign 1-year leases, let me walk you through what your real maintenance and vacancy costs probably maintenance cost expectations probably are. We'll just use the same example.
Okay.
So maintenance costs, we actually talked about 4 property turns at $2,500 each. That's $10,000 in costs. So maintenance cost equals $10,000, and you divide it by the rents that you would earn over a 5-year period. So $1,200 a month times 12 is 14,000 and something.
Okay.
Times 5 gets you to $72,000 in rental income, gross rental income.
Okay.
So that's how you figure out your maintenance cost expectation. Well, in this example, again, average residence days of 1 year, $10,000 divided by $72,000 is a 13.9% maintenance cost expectation.
Okay.
Not 5%, not 7%. Ask yourself why these other turnkey companies don't actually track the data. It's because they don't want to know. Because if they actually track the data and they put 14% for your expectation for maintenance costs, how many properties would they sell?
I wouldn't get my business.
No, nobody would invest in that way.
No.
But when they're signing you up with 1 year property management services included in it, meaning 1 year leases from the property management services, it's going to be something like this. At the core of it, this is why so many people get frustrated with rental property investing. And that's what really bothers me. It puts a scar on this entire beautiful asset class when at the end of the day, it comes down to misalignment of goals, and the management is so critical here. The management is so much more important than how pretty that spreadsheet looks day one when you buy it. So that's maintenance costs. Vacancy costs, very similar, right? We had $9,600 of vacancy costs. That's lost rent while your home is vacant. Divided by 72,000 actually comes out to 13.3%. That's real life. That at the end of the day is what people are experiencing, and that's what's marring their experience for rental property investing, and it's a shame.
Okay. So now we have this. I'm gonna share it again. That was a good talk through, and we're gonna get to the Q&A in a minute, right? We just want to get through this example so everybody understands it at a high level. So we have this example here where it's 24,100. You just explained the vacancy cost. You explained the maintenance cost of it all, and how that is what creates the disconnect between the experience and what they're selling you on the front end when it's aligned this way.
Mm-hmm.
So let's talk them through the JWB alignment for rental income properties so that our community can understand what they need to look for when they're looking at a property management company, how to evaluate that to know that they can save that $3,000 a year.
Yep. When you work with a property management company that is dedicated to long-term resident stays, and that actually makes more money when your resident stays longer, you can achieve amazing things for rental property investors. And at the core of it, that's what JWB does, right? So our entire property management company is focused around how long can we get your resident to stay? And it's this way if you're a turnkey investor with us, which means that you acquired properties with us. It's also this way if you're hiring us for property management services on a property that you didn't buy for us. When I think about the value for a standalone property management client to come in and get the same exact service structure, it's mind-blowing, because you're not going to find another property management company in Jacksonville who will tell you that they're here to make your residents stay longer, because they only sign 1 year leases. We sign long-term leases. So we sign 2 and 3 year leases. We'll sign over 1,000 of them this year. So all those people who say it's really hard to sign long-term leases, got to tell you, when you have a strategy and a team, and you are really good at making sure that the resident is going to win as well with a long-term resident stay and a long-term lease, you can do amazing things.
Quick point of clarification brought up here in the chat that is very relevant to what you're talking about, Greg. Her Francois says, how do you balance the fact that higher turns expense correlates with longer lease periods? I love my residents staying on for 2 to 3 years, but seems like the longer they stay, the higher the turns expense when they finally leave. Is that accurate?
You know, it's really not accurate. That at the core of it is why delaying and deferring your residents turning over is the winning strategy here. And Herb's a great client, and he may have had an example where maybe a resident stayed longer and maybe they had over a $2,500 property turn cost. So, I'm sure that's where the question is coming from. But when we analyze it over an entire portfolio of almost 4,000 properties, we have seen no correlation between a 2-year resident stay or a 4-year resident stay having having higher property turn costs. That at the core of it is how we win. There's not a correlation between longer resident stays and higher turnover costs.
Okay, there you go. So then talk us through the JWB incentivized kind of structure so that we can know how to save the $3,000 a year.
So for JWB, our average resident stay is about 4.5 years. Resident signs a lease today. They sign either a 2 or a 3 year lease. over 70% of our residents choose to stay with us and renew when that lease becomes, when they have the opportunity to renew that lease, and then they stay even longer. So on average, your resident stay is about 4.5 years with JWB. We're going to run through the same exact case study. We're going to assume a 4.5 year resident stay, and we're going to see how this plays out. So for JWB, or for a property management company that makes more money when you make more money by long-term resident stays, we're going to assume you're going to start with a $1,200 monthly rent, just like the other property. Same exact property, $1,200 monthly rent, but your resident's going to stay 4.5 years. Lifetime tenant placement fees paid. Well, you're going to pay one immediately when you buy that property, right? We're going to fill that immediate resident in there. And then because this is a 5-year case study and your resident stays 4.5 years, we're going to throw another one in there at the end of the case study. We're going to say that you paid 2 total tenant placement fees for your average resident with JWB. So that would be $2,400 total cost for your tenant placement fees. Your vacancy cost, well, because you don't have a turnover every single year, and because, like Herb's question was really timely, because you don't have 4 times the cost of a turnover, because the resident stayed 4 years, your turns are still going to be, or let me, before I get into kind of jump the gun there, Herb got me going there. Let's talk about vacancy costs a little bit before we get into property or property turnover. All right, vacancy cost. You've got one period of vacancy because you had one property turn while your resident was in your home there. That period is 2 months. So $1,200 times 2 is $2,400. There's your vacancy cost, right? It's not $9,600 like the previous example. It's only $2,400. You're winning here. Now, to Her's great point, the cost of repairs during your tenant turnover, still average of $2,500, right? Still an average of $2,500. You only had one of those. And so you're in at $2,500 for your property turn costs over 4.5 years there. You total all those costs up together and they actually come out to $7,300, right? There we go.
Right here.
There you go. Right before this, the other case study was $24,100. $24,100 versus $7,300. That's the big difference between loving your rental property investment or not loving it.
Yeah. And when I look at these numbers, Greg, and I think this is a 5-year case study, if I'm going to hold on to this house for 20 years, 30 years, right? So this is really going to happen 4 to 6 times, right? So this delta here of $17,000 is going to take place every 5 years.
Exactly.
So that's why we reverse engineer it to $3,000 a year. But really, when you think about the lifetime of the investment, it's an even more significant figure.
The longer you stay with a property management company that makes money this way, the more you win, right? And it's such a difference, right? 24,000 minus 7,000, right? Call it about $17,000, right? In real estate, you can make a lot of money, especially with home price appreciation, right? There are ways that you can make a lot of money over 5 years. This is about $3,000, give or take a little bit, about $3,000 a year that you're going to be saving by working with a property management company. Well, when you're talking about cash flow, when you're talking about the difference between you coming out of pocket or by putting positive cash flow, $3,000 makes a huge difference in as far as your risk profile and as far as how you feel about this investment, right? Because if you're like many of our clients, you've got 5 properties or 10 properties, right? An extra $3,000 a year from strategic property management times 10 properties, 30 grand, right? So it's really, really critical to make sure that you maximize your dollars and turn this from a negative cash flow example, which is what other property management companies who sign 1-year leases typically lead to a positive one. And it's so simple for you to tell the difference. Do they sign long-term leases? What's their average duration of resident stay? What's their percentage of renewal, right? If they don't know those numbers, I guarantee you, they're not paying attention to them, and you probably want to go the other way.
Say it again, Greg. What are the 4 questions you need to ask? Was it 4 questions? Do they sign long-term leases? What is their average rate of renewal? What else?
What's their average duration of resident stay?
Average duration of resident stay. Those
and
are
the fourth one. The fourth one is, how do you make more money when I make more money as an investor? You need to be able to answer that.
Yeah.
Right.
Yeah, that makes sense. So maybe that's the pillar question, right? You say, hey, I'm looking at property management companies. Tell me, how do you make more money when I make more money? And then you're expecting them to talk about longer stays, higher renewal rates, all the good stuff, right?
Absolutely.
Okay, great. There you go. So that is how you save $3,000 a month on property management. let's dive into some questions.
Well, let's do one thing, because I want, we get a lot of questions about the maintenance percentages for JWB when you look on our evaluations, especially those friends who are going to join us on Thursday for the Property of the Week show. I'm going to show you exactly how our evaluations look, and you're going to see your maintenance expectation might be 3% or 4%, or even 6%, depending on the type of the property.
Okay.
Right. So with this strategy, I'm going to show you how we actually get there. Right. Let's go back to that JWB case study. There we go. We're looking at it right now.
Well, not looking at it yet, but I'm putting my hat on and sharing.
Your hat is so spiffy. I like it. So for that one up top there, right? So maintenance percentage, boom, 3.5%. That's how we do it, right? We have our properties are renovated to an extremely high standard, or they're built new construction. But just as important, and even more important over the length and the duration of a 10 or a 20-year hold, how is your property management company having long-term resident durations of stay, right? That's how you get to a 3% or 4% maintenance cost. And that's actually what we get to. Vacancy cost, very similar, 3.3%. So there you go. That's the number one reason why other people are not happy with their property management companies. It's in that maintenance and that vacancy percentage. And the thing is, you know enough going into this to know what to look for, what to ask for with those questions right there.
Excellent. And that's why we put the show together, man, is to know the right questions to ask, to be able to inform the community. So hopefully everybody was taking notes. If not, good news, it's recorded. You can see it in the Facebook group right now. If you go to jwbfacebookgroup.com, we release it on the podcast later. We release it on YouTube later. Easy to find this episode. But really, if you're looking for great property management or you're looking to acquire your own property, rental income properties, go to chatwithjwb.com and get that process going. Gregg, just to clarify something, right? So we are talking about two different people that you serve. One is the rental property investor, that you are serving them from a turnkey angle. But then the other one is the Jacksonville person that bought a house from somebody else that is just looking for a better property management experience. How does that person, what is different from them when they're engaging with you, right? For me as a turnkey client, I know that I just bought the house, I'm in, right? Like it's a no-brainer, right? Like what does the property owner of a Jacksonville property that is looking for the best in-house property management company, like what is their experience coming on board?
So, when we brought you on board, and something we talk about often on the show for a turnkey client, we talk about how this experience is really built for the passive investor, right? Pablo, would you ever call yourself a real estate investor before you bought your 2 properties with us?
No, I would not.
That's not how you introduce yourself when you go to conferences.
I mean, I'm starting to right now.
You're like most of our clients. You would never introduce yourself as a real estate investor, right? You are looking for somebody to work with to handle this asset class for you so you can be passive. And along with that, you want no part of tenant underwriting or approving the resident or, anything that has to do with the property management decision. You just want to make sure that the team has your back and that we're going to make sure that we produce the best returns for you and deliver that monthly cash flow and put you in a great space for growth over time.
Correct.
Right.
I don't want to have to fix a toilet.
You don't want anything to do with that, right? That's a typical turnkey client for us. And that's why we handle the property acquisition for you, right? Along with everything else that we do. Property management client is what we would call somebody who already owns the asset and then wants to hire us for the property management services. So for that type of a client, generally that conversation of active versus passive it's even more important, because if you're an investor who actually acquired the rental property by yourself, or maybe kind of like the normal approach, maybe you worked with a real estate agent, you generally have a little bit more of an appetite for going out there and doing the dirty work.
Sure.
Right?
Yeah.
And you probably went out there and you found your property management company as well, and you probably interviewed them. You really did it the old school way, which is much more labor intensive and there's more risks along with it. But at some point you're okay with that because you did it, right? When we bring those clients on the property management side, we go even more down the path of, hey, let's make sure that even though you are really active on the acquisition side, when it comes to the management side, you want the same type of experience as Pablo. Right? You want to work with a team who has the experience and the strategy and the track record to deliver a better return on investment than probably you can yourself. Right? And definitely for a value of your time, you want somebody else doing that as well. So it's more important for us to make sure that that property management client does not want to get into tenant underwriting or approvals of residents or going through the materials that we use to actually renovate the homes and want to have their own materials list or anything of that nature. I mean, for us, it's really important that they want to plug into this successful system. And that's probably the biggest thing that we spend time working with new potential property management clients on the front end to talk about.
Okay, that makes a lot of sense, man. All right, so that was my question. Let's get into the crowd questions, right? So, and Greg, we got 11 minutes, man. So let's crank through these.
Love it.
All right. Julian Kidd asks, what resources do you recommend to get to know the Jacksonville neighborhoods and areas? I would say, first of all, we do have an episode on Jacksonville neighborhoods. If you look through the Not Your Average Investor Show podcast list or the YouTube playlist channel, there is one specifically on neighborhoods for you to understand the neighborhoods. But apart from that, Greg.
So, there is no national real estate market. Really, when you're coming to rental property investing, you have to work with a team that is so focused, so experienced in your neighborhoods, in your market to make sure that you can get the best team to work for you with the best experience, right? Because the best team and the best experience matters when you're trying to set a rent rate. It matters when you're trying to market for that new resident coming in. So, Julian, the best thing that you can do is spend time talking with those experts, right? Get on the phone with that property management company. JWB obviously would be one that you'd want to talk to, but talk to whoever you're thinking about working with and ask them some of the questions that we just went through today. I'm sure some of the things that we talked about have led to other questions for you as well. So go ahead and do that. The other thing that I'll give you just as a free resource is if you go to jwbpropertymanagement.com, there's actually a free instant rent price check. This is a great way to get to know the neighborhoods out there. If you go there, you click on free instant rent price check, you can put the property address for your rental property, and you're going to be able to see all of the JWB homes that are currently rented. So you can see what your property would rent for as well. So again, jwbpropertymanagement.com, free instant rent price check right there at the top, and you'll be able to get a lot of information there as well.
Good stuff, GC. Now we've got a question from our famous guest from France, Anonymous Attendee, asks.
Different than our previous friend?
Oui. Can you share some details of what maintenance is taken care of in-house by JWB and how it is charged versus what is contracted out of house by JWB?
Absolutely. So JWB has a construction team here. It's largely comprised of superintendents, right? We are not the ones, our internal employees are not the ones that are swinging hammers and actually doing the work on the house, right? We are there to manage and make sure that we get the best cost overall and to make sure that the projects are managed on time and on budget for you so that obviously it drives, and of course, make sure the quality of work is really, really strong to make sure that drives return on investment for you. Did I answer that one?
Yeah, it was what's in-house versus out of house. So basically you have kind of like most general contractors are general contractors. They understand the scope. They have subcontractors that work for him. You guys, as a superintendent, serve as a general contractor. You understand the scope. You have a book of business of people that you've done business with before in certain trades, and you manage that process. But it's not somebody from, not a JWB employee that's like looking inside that's changing the trap on the.
Sure. Exactly. We start with our general contractor, as a director of construction. Jim Marshall's our general contractor and our director. We have management team underneath him, largely comprised of supervisors and superintendents. And we do a tremendous amount of volume. We do over $3 million worth of construction every single month. And so when we work with those subcontractors, that vendor base, they all come into that incredible amount of work. And that's how we drive your costs down as a property management clients, because you get to leverage the buying power of JWB.
That is something that you didn't talk about at all in all the savings, right? Is the idea that because you manage 3,500 properties, because you start $3 million a month in construction costs, that maintenance percentage gets lowered across all the JWB owners. So whether you're a turnkey client or you're somebody that owned the property before, you get access to that buying power and the lower cost of labor and lower cost of materials that you're able to negotiate because of your buying power.
Exactly.
Okay, right on. So Peter N asks, for tenant retention, is 4-bedroom better than a 3-bedroom? Thanks.
Thanks for the question, Peter. This is one that I get every so often, and we haven't seen anything that would dictate a 4-bedroom home is better than a 3-bedroom home or resident retention. We love them both.
Easy peasy. And again, that's driven by the data flywheel that JWB has of 3,600 properties that you've been tracking for 14 years. And you know all these numbers. These are coming from real live examples that are propose to what you were comparing it to. I don't know if I used to propose right. Oui. Carl Thompson asks, when a resident leaves, what does JWB do to the property to prepare it for a new resident?
That's a great question as well, Carl. Thank you so much for being a part of the show. There is an entire team that is focused to make sure that the time that your resident leaves to the time that that home gets ready to go back on the market is as short as possible. So we're in great communication with the resident. We know if they do need to leave, we know what date they're going to leave. That JWB teammate is out there that day to make sure that the home now has a new scope of work on it. If it does need substantial repairs, we're going to make sure that we work with the vendors to get out there immediately. And we're tracking about 11 days, 12 days for the time that we take possession of the home until the time that it's back on the market. And some of those days are spent getting owner approval as well. We need to make sure we get owner approval if we spend over $400. And a lot of times, like I mentioned, especially on a property turn, you're going to need to get owner approval. So it could actually be even lower if you as an owner are very quick and get back with us with that approval.
Well, so that kind of answers Zach's. You said that was kind of a timeline answer, right? Because I think I moved it up and maybe you read this. He was asking about what is the scope that you normally do to the house?
Well, the scope would be about it's actually about $3,500 is the actual scope of work. And then I'm just simplifying it, but let's just say that house had a $1,000 security deposit on it. So $3,500 scope, $1,000 security deposit is actually $2,500 out of pocket for you as the owner.
Okay.
So $3,500 worth of work takes us about 11, 12 days to actually take it from the time we get possession until the time that we turn it over to marketing and put it back on the market.
There you go. And how long until you get a tenant in, right? This is Zach Correa's question is, aloha, Greg. How long does it take you to turn a property around in between tenants, right? Can you do 24 hours or what do you
it can happen 24 hours. I'm just telling you, and Zach, super appreciate the question. I appreciate you being on the show as one of our MVPs for sure. We have never put up leasing stats like we are today when it comes to renting homes. I mean, we manage almost 4,000 homes. We don't have a single that has been on the market longer than 30 days right now, right? I didn't look at it today. There's probably 15 or 20 homes that we have available for lease right now out of almost 4,000.
Wow.
So and I don't even want to tell you what the stats are because it's going to be hard to keep these things up, as we're doing the show years and years and years from now. I mean, the average days on market for us has been somewhere around 12 days, and it's probably going down now. So it's just incredible right now. It's a great time for you to be in rental property investing because there's limited supply of inventory out there. Rent rates are going up and absolutely a place that you want to be if you're renting homes.
Sounds like a good time to be a rental property investor. All right, Greg. Jen Filzen from the beautiful Monterey Peninsula has a question here. If a person owns rental properties in Jackson and wants JWB, the property management company, which we talked about, can they do that? Yes. If yes, how many properties do they need to own? Are you looking for people that have multiple properties? Is a one property a good fit for you guys?
Jen, thank you so much for being here. You are an amazing asset to this show. Longtime client. You and Renee mean so much to us. So thank you for being here. Great questions here. So yes, JWB Property Management serves other clients that didn't buy the property with JWB, but they just want these property management services, which you're not going to get any other property management company out there to sign 2- and 3-year leases, especially in Jacksonville. Is there a minimum number of properties? There's not. If you have one property and you want that property to come over and be managed by JWB and get long-term leases, you can do that. We can serve clients with our client that has the most properties with us, over 90 properties. That we can accommodate, even small apartment complexes. We just brought on an apartment complex that was 48 units a couple of weeks ago. So we're perfectly positioned to help.
Awesome. And we're going to close it out with the last question here from Zach Correa as well. Aloha, Greg, his patented aloha. Zach, a famous Hawaiian surfer.
Among other things.
Among other things. Also, most interesting man in the world. You might want to check out his interview on the Natural Average Investor Show. It rhymes with alpaca farmer. So he says, what's JWB's philosophy on tenant selection? Getting properties rented. Does JWB try to get top dollar and raise rents aggressively, or does JWB prefer more of a value play? Mahalo, Z. And I'm just preface this real quick that spoiler alert, next week's show is about this. Go, Greg.
There you go. So this is a common question that other property management companies pose to potential clients as well. They may say, well, we can either go for top dollar out there, but you might have to wait 2 months or 3 months to get the home rented, or we can come just below market rent and we'll make sure that we get you a resident very quick. I don't think you should have to decide between that. Like, I think a property management company can and should do both, right? Why can't they do both?
Preach.
Preach, baby. What? I don't know why they can't do both. So our approach is both, right? We want to get market value, top dollar market value for you and your home. And we do not want long-term vacancies. And we can do both, as you're seeing right now. Rents are shooting up faster than we've ever seen in our business. And I don't have stats on that yet. We'll have stats over time here, but I can just tell you internally, rents are rising and days on market are dropping. So you can do both. You shouldn't have to choose.
All right. You don't have to choose. You can do both. That reminds me of, there was a commercial when, I don't remember what they were actually selling, but it was when Deion Sanders left the 49ers to go play for the Dallas Cowboys.
Yeah.
And it was this like, it was some kind of like Domino's or Pizza Hut commercial where they're like cheesy crust or whatever.
Yeah.
And people are like both.
Yeah.
And then the last one was Jerry Jones asking Deion, so Deion, what's it going to be? 17 million, 18 million a year? And Deion looks at him and goes, both. And it's like a $35 million contract. All right.
There you go.
That does it for today. That is how to win at property management, how to ask the right questions. Greg, what's the main question that you need to ask when you're bringing on a property manager?
Anytime you're investing with somebody that is going to be a decades-long relationship, how is that person going to make more money when you make more money?
There you go. That's the number one question you need to ask. And when they answer you, they better be talking about length of stay. They better be talking about average renewals, and they better be talking about lowering the cost in the meantime, right?
Nailed it.
All right. So if you like that, you're going to love the Thursday show when we do the JWB rental income, where we dive into the property numbers with actual JWB inventory. It's a lot of fun. This was some high level nerdery out here today. Just wait till you get to Thursday where we actually go into it. It's purely audience driven. All the questions, bring them all. In the meantime, if you have more questions, if you, again, are looking for rental income properties, you want to be a rental income property investor, you're in the right place. Now you got to go to chatwithjwb.com. If you're looking that you own a property, you want it managed this way, somebody that sets up their long-term incentives with winning when you win, making more money when you make more money, go to chatwithjwb.com. And if you're a real estate professional that wants the edge on the Jacksonville market, this is it. We're giving you this education every week. And if you want to know how you can make more money when we make more money at JWB, go to chatwithjwb.com and make more money when your clients make more money.
Did you mention make more money?
Make more money. Make more money. That's kind of it. Man, it's funny, Greg. We don't normally we don't talk a lot about like make money on the show, right?
It felt a little weird when we were just talking about that.
It is weird now that you just brought it up. But at the end of the day, this is the asset class, right? And I think that when you position it as how do we make more money? How does the client make more money when the company makes more money? How does the investor make more money when the property management company makes more money? I think it's not a bad word to talk about money when you're just talking about aligned incentives.
And especially when you're talking about with real estate professionals out there. Real estate professionals are masters at partnering with builders, right? Or inventory sources so that they can provide assets for their clients or education or knowledge. That's what the show is. So if you're a real estate professional out there, you're having a hard time finding inventory. If you want to see actual available inventory, come to the show on Thursday. You're going to see our property of the week. And we'd love to have you. We'd love to partner with real estate agents as well.
All right. And that does it for us today. It is never lost upon us that we had 50 plus people on this call the whole time. It's the middle of a Tuesday, middle of the work week. We are truly grateful that you find the value in spending time with us because we love spending time with you. So thank you so much. If you want to hang out with us more, go to jwbfacebookgroup.com. Join the Facebook group that has almost 3,000 rental property investors and property owners and real estate professionals. I want to make more money just like you. And I'll leave it up to you, big guy, to say the last words.
Fun show. Got to jump on my soapbox a little bit. These are some of the things that both I'm excited about and that I also, I think it's a shame about our industry. So I hope you guys learned a little something as we kind of peeled back the onion of what it's like to actually own a property management company and that you can use this information to make sure that you're jumping into a property management relationship that is going to be fruitful. that's going to deliver the best risk-adjusted returns for you and to make you happy and excited about your rental property investments.
I learned I got to put on the hat.
Keep the hat on.